Good afternoon, everyone. Welcome to another edition of our Wednesday market review. My name is stockdarts, and as usual, we're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we conclude with that, we'll take a quick look at the U.S. dollar, see how it's behaving, see if it's affecting gold or silver, and then take a quick look at oil. And once we finish that, we'll go move on to the chart requests. If anyone that joins has a chart they're looking at, feel free to add it into the chat, and I will go ahead and take a look at it once we finish with the regular market review and see if we can figure out what's going on with those charts. If you like what you see today, you can always follow me on Twitter at stockdarts. You can find me on YouTube at stockdarts, or you can visit me at patreon.com/stockdarts, where I post weekly blog content. I usually put a post on Monday looking for whatever types of trades I'm looking at for the week, and then on Wednesday we'll repost these on the Patreon page, and then throughout the week, if I find a good trade that I like, I'll go ahead and post it on there as well. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. Let's go over here to SPY and see where we stand. Now, we've had an interesting week since last Wednesday. The market, for the most part, has really not moved much. We had a nice move at the beginning of last week, and as you can see, we're pretty close to all-time highs, and overall the market is, I think, holding up and doing a pretty good job of getting ready to try to rally. Now the question is, of course, we're not really finding enough momentum to push forward, but I like where we stand, and I think that really we're in one of these calms before the storm where the market is really just trying to hold up and trying to build up enough pressure to be able to push through all-time highs and start to rally further. Now we're not really ready to do that yet, and I think part of the reason for that is that we're still at a bit of a crossroads. I think we're still finding a lot of selling pressure, and I think we're in a market right now that for the most part is really just neutral. And while I do like the setup right now, and I think that we have the potential for a rally, I think that we're also still, for the most part, in a market that is not ready to move. And until we actually see that move, we have to assume that the status quo remains the same, which is, of course, a neutral market that is trading sideways. And that means that there could still be a lot of false moves back and forth, and it could be setting up also for a little bit of a pullback and to test some prior support. But what I like is that the fact that right now, as long as we hold above the immediate support levels just below us, I think that the market is still overall in a good place, and I think it bodes well for a rally into the close of the year, particularly now once we start getting into the holidays, once we get past Halloween and start approaching Thanksgiving, and then of course the holidays around Christmas, which is typically a point in the year where the market tends to kind of drift higher anyway. Of course, last year being a kind of a pretty big exception to that. But for the most part, we usually can expect some good action coming into the holidays. And I think that the market could be setting up for an attempt at a rally through there. But for now, we're still kind of range-bound, and I think that's where we stand. And as we go through these four major markets, I'll go ahead and give you my thoughts on why we are at the moment still in a neutral range, and why it looks like maybe we need another few weeks before we really set up for a strong rally. Now, if we look at, again, the S&P 500, you can see that we're kind of drifting upwards, but we're not really putting a lot of pressure as far as trying to climb. For the most part, we're just sort of consolidating in a slightly upward trajectory. Typically, this eventually resolves with a pullback. What happens is you keep getting buyers that are slowly chasing the price action higher. As price action consolidates, you can see volume still declining. So for the most part, this isn't indicative of really a strong rally upwards. It's more along the lines of a consolidation that is not giving enough or not finding enough selling pressure to come back and test its prior support, and buyers continue to kind of just chase it a little bit higher. It's not a crazy overbought sort of condition where buyers are going crazy chasing higher. They're just sort of stepping in a little bit quicker than normal because they don't want to be left behind once we do push the highs. But what ends up happening in this sort of situation is, more often than not, eventually those buyers that are kind of coming in at poor prices will be the first ones to abandon it, and you end up getting a pullback. So for now, it looks like we're setting up for a possible pullback, and I think the question becomes, if we do pull back, do we hold above this 293 to 292 area? You can see the 20 and the 50 pair moving average holding up just below price. To me, an important line in the sand here is this green line, this 293 area. I think that this is a critical spot where we are expecting to find support in the market. If we go back and we take a look at a longer term chart, we could see that that was a pretty good ceiling for price action in 2018. And while it hasn't really been a good floor so far, it's been a pretty good turning point. We've been going back and forth through that level quite a few times over the last 3 or 4 months. And I think that that becomes an important area for us to try to maintain as a support level. Welcome those of you that just joined. We're going to go through the four markets as usual and then look at some commodities and the US dollar. Once we finish with that, we'll take chart requests. So if any of you guys in here would like to see my take on your charts, feel free to add it into the chat, and I'll take a look at it when I get a chance. So with the way the S&P 500 is behaving, I think as long as we stay above 293, that we're still in a really good spot, but we're still ultimately just consolidating. We're still ultimately just trading sideways. If you look at what we've done since June, basically, we've been stuck in a range between about 302 and about 282, which was the area that we broke out from back when we had that pullback in May, and then we eventually started to rally in June. And once we broke this downward trend, this retracement, which was at that point new all-time highs, we made our way to new highs, and then we've just been going back and retesting that level and just trading sideways. You can see we've really just traded in a range. And there's not a lot going on right now other than the fact that we are holding at the top of that range. And what you want to see when you have a market trading like this is the last time that it comes up and tests highs, you want it to come back and you want it to just test maybe half of the range and then come right back up and try to surge past it. And that's what could be happening right now as we speak, and what is actually happening in the longer term on the weekly chart, where you have, again, a range that's been holding for quite a while, and now at the end we're sitting here coming up and trying to test the top of it, and each time we've pulled back, we've sort of maintained our price action in the upper edges of that range, showing that price action is starting to view these highs as an area of value as opposed to an area of too high priced and of supply. So overall, things are developing in the right direction for us to break out, but we're not there yet. I think at the moment we're still neutral, and because of that, there is always the chance that we pull back again. So let me get rid of this box. And if we do pull back, I think again what we want to see is on the smaller time frame that same sort of pattern where we're ranging back and forth, but we start to pull back more and more shallow each time and hold above some of these critical levels. So again, you can see the moving average is starting to curl up, and you can see the last time we pulled back, we did continue to sort of maintain an upward trajectory, right? If we take this trend line and we turn a little bit, you can see that for the most part we have been slowly climbing, even though we've been trading sideways. It's pretty shallow. There's not a lot going on there. I actually prefer to just maintain this trend line as a level of support, but overall you can see that it has become a little bit more constructive each time we pull back. So if we do pull back off of this little ascending wedge that we're forming right now, ideally we'll hold above 293, and I think if we do, I think that's a pretty bullish sign, and I think it's a sign that we are making our move back towards highs and hopefully breaking out as we head into November and into the holiday season. Now, if you're worried, if you think that the market is still, not only do you think it's not really neutral, you think that we're in the process of topping out, well, you have a warning signal, right? The first warning signal is this 293 area. As long as, if we fall below that, then I think that's your clue that the market, again, was really not ready to break out, and more likely than not wants to come back and retest prior levels. So if we do lose 293 to 292, well, then you know that we're probably going to head back to a 200-period moving average, and then if we lose that, well, you know we're going to head all the way back down to 281 to 280. So you have these intermediate levels that you can look at as these sort of warning signals, right? You have warning signal 1, warning signal 2, and then warning signal 3. And if we get to all three, well, then you know we've got a full-blown situation here where you need to be more careful and you need to start to rein in risk and to really raise more cash and prepare yourself in case the market wants to keep dropping back. So you have these three different levels. So if we get to maybe 293 and we start to fall below that, well, then that's your first warning signal. At that point, maybe you decide you want to start being a little bit more tight with your risk on trades or on holdings. And then if we get to the next level, you could start to start raising more cash and start to look at stopping out of more trades. And then again, once we get to that, at that point, then you can really start to figure out exactly where the market wants to go. But until then, as long as we're up here holding up near all-time highs, we can still be bullish. And the only thing we have to worry about is making sure that we're disciplined and we're not chasing price action higher, that we're taking good risk-reward setups, and we're attempting to position ourselves in a place where we're not going to get caught off guard by timing or by setups that are maybe, they've gone up 5 days in a row, and then we just get in a spot where the normal ebb and flow of the market is going to take it down for a few days, and you stop out because you just had poor timing. So we still want to have good risk reward, and we still want to maintain discipline. And I think one of the keys to maintaining discipline right now is keeping an eye on earnings season. We are now in the middle of probably the busiest 2 weeks of the earnings quarter. And you want to make sure that you are not putting yourself in a place where you're going to get surprised by a lot of the extreme volatility that accompanies a name when they report. So take a quick look at what's reporting today. You can see we got Tesla, Microsoft, PayPal, Ford, a couple of the bigger names. And as you roll down here, you can see that there's plenty of names. And if you're looking at taking a swing trade, make sure that you come to any one of these websites, whether it's Earnings Whisper, whether it's Option Slam. There's a bunch of them on there. Even if you just go to the regular Yahoo Finance or Google Finance and just take a look at whatever the earnings date is on the stocks that you're looking at, and make sure that you don't get caught in a swing trade where you're not anticipating extra volatility coming in, because a lot of names can move 5-10%, and sure, it could go in your favor, but it could also go against you. And if you can't really control your risk, then you're not doing a good job of setting yourself up in a good place to be a profitable trader. Number one goal is always to make sure you control your risk. And if you're entering a trade where you don't know whether that 10% is going to go in your favor or not, and it's not part of your overall plan, then you're trading with poor discipline and you're putting yourself in a position to fail. Now, I'm not saying to avoid trading earnings. I actually enjoy trading earnings, and I use a lot of different trade setups to trade an earnings event. But it's not a directional swing trade where I'm just buying shares and then looking for a long play. Usually I'm going to use options in order to reduce my risk and to make sure that I have a good risk-reward setup and a good probability of success depending on those types of trades. And if you have any interest in those, I do share them every now and then on my Patreon page, so you can always go and visit that and get a better idea of what types of option plays I look for. All right, so those are the key levels on the S&P 500. Basically it's 293 to the downside as far as our short-term support, and I think really the critical line that we need to pay attention to as far as whether this market is going to maintain this bullish possibility. Obviously, to the upside, we need 302. We need to break 302 to 303 to start probing new all-time highs. I don't know that we're ready for that yet, but I'm hoping that we'll be ready for it in maybe the next 3 or 4 weeks. At least as far as rallying past it. We could come up and probe them and maybe come up by a few pennies or even 50 cents or so. But as far as pushing past them, I think that we need more time. And we'll get to that once we get to IWM as to why I think that we still need more time to get to that. Again, if we lose 293, then we'll start to look at this area around the 200-period moving average and our last pivot as the next level of support. And then beyond that, this is where you really start to worry about the market, is if we come back down to 280 and start to backtrack and lose this upward trajectory. If you think about it, despite the fact that we've pulled back several times as we've hit highs, the market hasn't gone backwards. We haven't come back and sort of lost ground. We continue to advance forward and continue to push higher. And as long as we continue to do that, we can still assume that the market is trying to make its way to new all-time highs. Once that pattern changes, well, then that's when we have to reevaluate and figure out what the next step is. All right, so we look at the NASDAQ. We're going to see a very similar picture. In the short term, we've had a little bit more weakness. It's not quite the rising wedge we're seeing in the S&P 500, but for the most part, all we're really doing is consolidating. You can see the declining volume showing that we're basically just kind of seeing some profit taking and just shares exchanging hands just below all-time highs, trying to set up for a move through that, and we're not there yet, right? That's, I think, the key, is that we're just trading sideways right now. There is room for us to fall back a little bit further, or there is room for us to push forward. But I think the key is that we're really just consolidating. You can look at this as almost like a bull flag. right? We had the nice rally up, and then we're just kind of consolidating. It's a little bit wide, and I think it's a little bit too clunky to be really a bull flag. But overall, this is, for the most part, just it's the same behavior, right? We had a bounce, we had to move up, and then we're just taking some profits and just consolidating and waiting for an imbalance is typically what happens when you have a consolidation range like this. This is when buyers and sellers are equally matched. There's just as much selling pressure as there is buying pressure. And what we need is for an imbalance to occur. We need some reason for buyers to overwhelm the supply that's left, or the other version is that there's not enough buyers left, and then they come back and then the market probes lower to figure out where those buyers are waiting. Now, if we do probe lower, you can see that there's a good spot here just below us, around 189 to 188. We've got the two moving averages curling up just like the S&P 500. We've got our previous level of what was a resistance and then temporary support and then resistance again, which should again flip to support until we break back below it. Now, a lot like the S&P 500, this level here, which you can see between about 190 and 188, right? It was it was a ceiling back in 2018. And right now, it's not really necessarily a floor as much as a pivot point where we just keep going back and forth through it. It's almost like the midpoint of the range that we've spent the last 3 or 4 months in. And we're kind of trying to hold above it. And just like I mentioned with the S&P 500, the idea here is, as you can see, we keep finding buyers higher and higher up, right? So there's a transition here where buyers assume the 187, 188 on the Nasdaq was too high priced, and it wasn't a good value last year. And we're slowly flipping that, where buyers are now starting to see this as an area to go ahead and try to get in long, and they consider it an area of value. Now, that might not hold. We still are finding a lot of supply and a lot of selling pressure here, and it could be that it overwhelms the buyers again, and if that's the case, we're going to drop right back below that level and head a little bit lower. But for now, we can see that the buyers, their attitude continues to improve, and they continue to push and probe and try to push the market upwards. And they continue to buy it at higher and higher prices, despite the fact that we continue to find pressure. That's, for the most part, signs of what is probably a rally coming, but it's still not 100%. I think it's still more like a 60-40 or 70-30 that we try to push higher, because I think the fact of the matter is that we're still trading sideways, and we still haven't been able to really push through what has become a pretty strong wall. From basically June to now, which is this 194 to 195 area on the Nasdaq. And if we do pull back again, I don't think it's the end of the world. I think that there are a lot of different levels that could offer support. And if you go back to the long-term chart, there's a long way to go before we really come back and even retest the middle of last year's range, let alone the bottom of last year's range. So overall, there's a lot of room. Now, that doesn't mean you should just hold blindly as we come back and test those lower levels. That's still a pretty big move to the downside, and you don't want to really just absorb that for no reason. But our attitudes should still be one of a market that's in good shape, even if we start to pull back and test some of these lower areas, because I think in the long term, we're still in a good place in the market. All right, if we move to the Dow Jones, you'll see the Dow Jones is in a little bit of a different place now. They had some earnings. The Dow Jones obviously has a lot less components than the S&P 500 and the Nasdaq, so we're going to see some adverse moves like this during earnings events. But for the most part, it's really just doing the same thing as the Nasdaq and the S&P 500, which is consolidating after finding a bottom in early October. You can again see the declining volume as we've just chopped sideways. The moving averages are still curling underpriced and still trying to support it. We're still above our key area here, which is this 265, which was the ceiling of the price action in August and September, and then recently in the beginning of October before we were able to break past it. But as you can see overall, it's still kind of in a bullish place, right? Because we had, last time we probed to new all-time highs, we kind of pulled back, and once we fell below 265, this was kind of a scary place to be, but we were able to push past it. We broke this downtrend. So overall, there's a sentiment shift here, right? Because the sellers were in control, and then buyers took control. Easy way, we just flip these trend lines, and you can see the buyers took control of the price action, and they're kind of struggling right now. For the most part, there's so much selling pressure at these levels that the Dow Jones hasn't been able to break past it. But overall, we're in a more bullish place right now than we were a month ago, and the key really becomes how we sort of emerge from this consolidation range that we spent the last week and a half in. If we can push back to the highs and push past it, then we're going to go ahead and revisit all-time highs. If we don't, then we need to come back down and retest this prior level that was basically, it was resistance turned into support, turned into resistance, turned into temporary support, and then into resistance, and now hopefully into support again. So again, it's the midpoint of the range we're trading in, but ideally when we're trading in a broader base like this, you want that last time that we come up and test highs, you want the consolidation to stay just above the midpoint and then push past it, showing that, the attitude is flipping where buyers are getting more aggressive and more bold as we come towards the end of that consolidation range. So hopefully that's where we are. If it is, then maybe we can see us push past that. I think that a lot of it is going to depend on what the earnings reports are over the next couple of weeks. We've got a lot of big names reporting. We still haven't seen Apple and Amazon report, Facebook, and as those names start to report, we should get a better idea of where the market wants to move next, and if it is hopefully ready to push towards new highs and start to explore a rally, or the idea of a rally into the close of the year, which I think would be great. Now, it might not happen, but if it doesn't, I think that it just means we're range bound. I think it still means we're neutral. I don't necessarily think that we're going to have a close like last year. We go back and take a look at what happened last year, because last year we were doing sort of the same thing, right? If you come back and just take a look at how we closed last year, there was a point where the market was just probing to highs, and then it started to pull back, and then it just kind of lost all of its momentum. And it started trading sideways before it really broke down. And we're kind of trying to do the same thing again, where we're just pushing back towards those highs, and at this moment, we're kind of consolidating just below the highs. But we haven't found that volatility from last year yet. It looks like buyers are a little bit more bold this time and trying to push us through it. And as long as we don't lose some of these neutral areas around 250 to 260, and clearly 265 in the short term, then I think we're okay to try to push it past that. And I think we're in a different place from last year. And so even if we don't push the new highs, I think more likely than not it means that we need to spend more time trading sideways. And I think a big reason for that is of course the small caps. If we look at the small caps, you can see that they're not in the same place as the other three indices. They're not even close. You can see the range we spent the last couple of years, and you can see that IWM is still struggling to get towards the midpoint of that range and to get back that it's nowhere near all-time highs. And matter of fact, it's actually been hovering pretty close to the lows of the majority of the price action over the last couple of years. Of course, we broke down pretty sharply below it at the end of last year, but I'd say most of the price action has basically been between 145 and 170, and you can even actually say 145 and about 160. And I think the key is if we can get IWM to push past 158 to 160, that would actually be in my mind, the sort of the starting horn or the rally horn to say that we're ready to push past the highs on the other three indices and rally towards the close of the year. You can see every time that we've tried to break through that this year, IWM has been rejected pretty stiffly and has actually led to the larger retracements in the overall market. We tried to come up here and failed. Then we had this was the really big turnaround where we tried to break out and failed, and that led to the big pullback in June, which in IWM's case actually led all the way back to the bottom of our range. And then recently again we came up and tried to break through it and failed a couple of times. So that is a really critical area, and I think that is the most important line in the sand as far as watching for a major breakout in the market. So what I mean by major breakout, I don't mean probing to new highs like we did earlier this year. I mean more along the lines of, if we go back and take a look at the S&P 500 for a second, I don't mean this, like printing new highs like this where we're just kind of making our way forward. I think if IWM could get past 160 and actually push through that, I think we're looking at a rally like this. Like what we saw back in 2016 to 2017 where you have a real strong move upwards that lasts for a few months at a time, if not for a year. And I think that we could be setting up for that. We're not there yet. I don't want to get ahead of ourselves and say that we're going to do that. But I think if IWM can actually break past this big area, 160, there's a lot of vacuum here before we get towards IWM's all-time highs. And I think that would, being able to push through all that, would show that buyers are getting aggressive. Because again, if you think about it, IWM, the Russell 2000, those are the most volatile assets in the market. If a trader is, you get this you get this idea of greed and fear, right? A lot of times people look at the market and they say, well, is it greedy or is it fearful? And in a greedy market, a market that wants to run upwards, where traders are just ignoring risk, they're going to take trades in volatile assets, right? In a fearful market, they're going to avoid volatile assets. And as you can see, despite the fact that we've been in a pretty strong market this year, traders have been scared to take risks, at least with the small caps. You can see that they've been avoiding them. And every time the market starts to pull back, the first place that they abandon is the small caps, the volatile assets. So if you want to have a market where the attitude is really bullish, where traders are kind of throwing caution to the wind and looking for as much return as possible, we're going to have to see IWM, we're going to have to see the small caps participate a little bit more than what they've done. And I think that the key is to get past this 158 to 160 range that has held the market and held IWM in particular in check all year. So that to me is the key area. And I think what we want to see now, I don't think we're there yet. And that's why I think that the market's still neutral, despite the fact that we've seen nominal highs over the last couple of months on the S&P 500 and the NASDAQ. But not really a rally past that, is because the attitude isn't there yet. I think that there's still traders that are a little bit fearful of us being on a market top and of a market that's going to roll over. Last year scared traders a lot, and I think that they still haven't really overcome that. And to tell you the truth, most traders still really haven't overcome what happened in 2007, 2008. And so that has led to one foot out the door for the last decade, despite the fact that the market has rallied incredibly. So that's, to me, the important signal. Now, if we look at the short term, right, we've got this is a little bit more like what we were watching in the S&P 500, where you've got a little bit of a rising wedge. So there's potential for us to pull back. And I think that at the moment, in the very short term, I think there's more potential for us to pull back for a few days than to continue climbing upwards. But these patterns sometimes persist a lot longer than you'd think. And there is a chance that we continue to climb higher. But if we do continue to climb higher, it doesn't really offer us good risk reward. And you can see it, I think, pretty clearly in IWM compared to, maybe the Dow Jones and the NASDAQ had a little bit more of a horizontal consolidation. But the S&P 500 and IWM, I think you can see that at the moment we're just kind of drifting upwards. And the more we drift like this, the poorer the risk reward becomes. So we still have to be pretty disciplined as far as what kinds of trades we're taking. If we do pull back, though, what we want to see is we want to see a pullback into these moving averages. We don't want to see a move all the way back down to the lower 140s. And then from there, hopefully we find some support around the moving averages and then start to make our way back upwards. And I think that would coincide with the other three indices coming down to their immediate support in the short term, all those green lines that I had on the charts. And if we find support there and start to make our way upwards from there, then I think IWM has a good chance of making its way right back to 158. And then we'll see. Then that's the big test. I think that'll be the big test to decide whether the market wants to rally into the holidays or whether we're going to just chop around and continue to just trade sideways, looking for news or looking for any other excuse to prop the markets in one direction or the other. All right, so that's the four major markets. I think as far as trading this week goes, I'm more concerned with earnings trades or post-earnings trades like the one I posted on Monday on Patreon. And I'm really looking at a lot of trades that aren't really correlated with what the market's doing. This is kind of my favorite time of the year to trade, is just to look at earnings names and try to trade whether it's calendar spreads or condors or stuff like that, to take advantage of the volatility that comes into the options during this time. But as far as swing trading in the market is concerned, I think we're in one of those spots where it's difficult to find a lot of trades because we're in the middle of a range. We're not really going anywhere at the moment. Again, if you take a look at the S&P 500 and you look at where we are, we're trading sideways. We're kind of caught in it, and the risk reward's not great to the upside. The risk reward to the downside is a little bit better, but we're kind of in a bullish place, so it's a little bit harder to really respect a lot of shorts. Although I have seen some short setups that are looking decent, but they're also getting violated because the market continues to kind of climb and push it through those levels. But so at the moment, it's just we're in a neutral spot here where if you find a good setup, you can go ahead and take it, but understand that the market itself is not really at a spot where it's going to give us good movement in either direction. So that's the four major markets. Let's take a quick look at the U.S. dollar. Again, if anyone is in here we have a decent amount of viewers. If any of you guys have a chart you're looking at, you have a question on a chart, feel free to add it on here. I'm going to type it out just in case. I'd love to see what you guys are looking at, and maybe you find something that looks better than some of the stuff I've found. But for now, let's take a quick look at the US dollar now. This is kind of interesting for me because I expected, with the US dollar kind of struggling here, I expected more out of gold and silver, and they haven't really done anything. But the key here is, again, for those that have been watching and know that I like to look at the Forex markets to get an idea of what the dollar is doing, the euro finally found the bottom. We mentioned this last week and the week before. You can see it had a strong move past that. Once it finally broke this this bearish trend, it had a really strong move. It actually broke past what I expected, which was I thought it was going to struggle around 110.80, and it pushed past it. Now I think it found a pretty strong wall here, even though it's kind of setting up a quick consolidation range and wants to come up and test that again. I think that for the most part, the euro probably needs to spend a little bit more time backtracking and building out a base. I don't think it's going to make I don't think it's going to make its way all the way back up to 114. At least not right away. I think it's going to spend some time in this area, probably between about 112 and just below 111, around 110.80 to 110.60, somewhere in here. But I think overall that we've probably found the bottom on the euro, which means that the US dollar has probably found the top as an aggregate. Again, this chart is inverse for those that maybe aren't comfortable with this. This is the euro US dollar, so it's priced in the euro, and so up is good for the euro, and down is good for the US dollar, which is different than, of course, in the US Canadian, which is price based off of the US dollar. So in this particular case, up would be good for the US dollar, and down would be good for the Canadian. And as you can see, the US dollar has lost a lot of ground versus the Canadian dollar as well. So the US dollar in general is starting to struggle a bit. It actually was trying to break out and trying to push through, and it lost a lot of ground here, which means oil probably bounced as well. And then finally we have the US versus the Japanese yen, which is the third cross that I like to look at. And as you can see, in this particular case, the US dollar actually is still holding value, which is probably more a function of yen weakness than US dollar strength. And it is printing a very nice inverse head and shoulders. So if it does break past 108.70, there's a lot of room to the upside. And typically if you look at it, the potential move here, it's a pretty big move. You could probably look at a move all the way up to 110.5 to 111, and possibly all the way back up to 112. So there is room to the upside. For those of you that like to trade currencies, there is a potential chance for the US dollar to break through here. And if it does, I think that there's a lot of upside on what could be a trade that takes a few months to complete, but it could be a pretty big move back up all the way up to 112, really, based off of this type of bottoming pattern. But I think overall, what we're looking at again is the US dollar as an aggregate is losing ground. It broke this ascending trend. Now there are levels of support. It lost this level around 26.75. We got another level right just below 26.50 that could be a key area. And then from there, it probably needs to base out, just sort of the inverse of what we saw in the euro, where it's going to need to spend some time like this. And I think with this drop in the euro, or in the US dollar, I expected gold and silver to have the relief to be able to move freely and start bouncing with, because the stronger the US dollar is going to be, the more it's going to put downward pressure on gold and silver, because again, gold and silver are priced in US dollars, so there's always going to be an inverse correlation between them. But that hasn't really been the case. Gold has still kind of been struggling. Now, it is kind of stuck in this pretty big triangle, and it's getting close to the apex of that. So we're going to have a move back and forth in one direction or the other, and it's probably going to be related to whatever move the US dollar does make. But for now, surprisingly, there hasn't been a strong enough move off of this. And I was looking at trading gold long, and it really hasn't given us much of a move yet. For those that follow me on Patreon, we were looking at Kirkland Gold, and it really hasn't triggered a long play, and it's actually pretty close to kind of going in the opposite direction if it can't really push past 45. But yeah, I expected more out of it. The other trade that we were looking at was TRX, and that one actually, again, never really got going. It's kind of actually falling below support now. Now, there is still hope for these. if they could kind of turn around and these could end up being sort of false moves to the downside. And risk reward is still good if it actually does get some momentum. But for now, we have to kind of wait for gold to prove it now. So we want to see at least the first signs of buying before we go ahead and try to take a long play on gold. I think the risk reward is still pretty good here, and I think that there's still a chance that they move. But at this point we're going to need to see a little bit more weakness in the U.S. dollar, and then see that actually turn into a show of strength by gold and silver, which at the moment just hasn't been the case. And then finally, the other commodity we like to look at is oil. And as we can see, oil is starting to make its way upwards. It excuse me, it has been struggling quite a bit. If we look at what happened here, and again, that big gap up was news related, and it basically faded the entire event. It came all the way. At this point, we can assume that 51 is pretty good support, and this area around 60 is pretty good resistance. And where we stand right now is kind of at the bottom of that range and starting to make our way upwards. Now, the problem here is that the risk reward is still not great to look at oil to the long side. We've got probably a move to about 56 before encountering some pretty strong resistance. But I think overall it does show that oil found a bottom. And if you're looking at oil-related names, you can look at a possible play to the long side on them. Based off of this pattern, if you see a pattern like this on another oil name that maybe isn't quite as it has a little bit better risk reward than what we see here, because the problem with it right now is 55.36, and you'd have to have your stop down here somewhere around 53. So that's about 3 points or 2.5 points of downside, and then you've got maybe 2 points of upside before we get into our first level of real resistance. So we need to wait and see something here, but at the very least we saw oil find a bottom here, so that means we could look at some oil names if we want to. So that's the markets. Those are the commodities I like to look at. We have a little bit of time. If anyone has a chart request, now's the time to add it. If not, there's really not much else to talk about. For those that are curious, we did take a trade this week on Netflix on my Patreon page. It was a calendar spread looking for Netflix to stay range bound somewhere in this area. And we're kind of towards the lower end of that range, but I think overall, because of the way options volatility works, I think it's still working out okay for us. We get another day or two into expiration this week, and I think it'll end up being an okay trade for us. But that's like the one other thing I'd like to share, I guess, while I wait to see if we have a chart request. If not, I'm going to close up shop in a second. But just to give you guys an idea of what we're looking at and why I'm kind of not really trading the market that much is after earnings, you tend to get these different trade ideas that you could take based off of what companies did during earnings. Or if you wanted to trade into an earnings event, you could do that as well. But in Netflix, what we did in this particular case is Netflix had a pretty strong gap up after earnings and then faded it pretty quickly. And then it finally found some support on Monday. And despite the fact that it broke down yesterday, it's kind of coming right back up and trying to hold value here. And while it is kind of struggling here, the beauty of options and the beauty of trading volatility is that as long as you don't get too much of an adverse move that goes against your direction, if you're taking advantage and you're trying to sell premium, it still works in your favor. And I think at the moment we're still in an okay place here because we only have 2 more days for the calls that we sold to expire, and then we have a week to go. We took a calendar spread, so we still have a week on the calls that we bought, and there is a chance that we try to flip this to a bullish play depending on what kind of candle pattern it takes in the next couple of days. But I think overall it's still working okay for us, even though it's not working quite as well as planned. Ideally, we want Netflix to be closer to 280, but we're not that far away, and we still have a few days to go before we have to make a judgment call on whether we want to run it into next week or just close it out today. But yeah, that's a recap for any of you guys that are Patreon subscribers on what we did on Monday and where it stands right now. Other than that, I hope you guys have a good rest of this week, and we will meet again next Wednesday.